Hello and welcome to this Monday's weekly morning market briefing. We've got lots to talk about, but firstly, US lawmakers have passed a short-term bill in order to avoid a government shutdown, which did seem imminent last Friday. As well as that, British exporters are being hit with a carbon tax from the EU, these being British exporters to the EU, which is the biggest market for Britain, which could demonstrably, hurt British exporters and British industries. As well as that, Rishi Sunak will not cut taxes going into next year's election year, and this is coming as he is speaking at the Conservative Party conference in Manchester. But there's lots to talk about, especially on the charts as well, with US indices being in a really interesting position, as well as the dollar, and also lots to talk about on the economic calendar and lots of data coming out this week. We'll come to that near the end, so stay around till then. But let's get straight into it. So firstly, the US Congress has voted to avert a government shutdown after lawmakers agree a last-minute measure that keeps the government funded until mid-November. Now, every year, a budget is passed, and due to the split of Republican Democrat within the Senate and, Republican-controlled House, this has, as a result, caused an issue with passing, certain debt and government bills in relation to the budget. And this, however, does leave, and as a result, they were unable to kind of get an actual bill passed. Therefore, Kevin McCarthy has managed to get through a temporary bill, which will only last 45 days, but covers the most essential kind of industries and policy areas of the government. Now, this, however, does leave many sectors still hanging in the air without funding, such as Ukraine, which is increasingly becoming an even more partisan issue within both parties in relation to whether we should continue funding them anymore. And this has kind of become an issue, and as a result, such a controversial issue nowadays has been left out of such a temporary budget, which is just trying to get passed so they can have some money in the meantime until a larger and more, kind of a larger, wider ranging bill is brokered. Now, this came after the Senate voted 88-9 on Saturday night to approve the deal, which was brokered by the House of Representatives earlier that day. Now, Joe Biden then signed the agreement before the midnight deadline, avoiding a shutdown, as if a shutdown did occur, thousands upon thousands would be furloughed, and people would essentially not receive their wages. Army personnel would not receive their healthcare benefits. A wide range of issues within federal agencies as well, with many people just going home and not being able to work, which is obviously a large issue and brings the US to a standstill. Now, earlier that day, the House had voted 335-91 on the deal that keeps the government funded at their current levels for another 45 days, with all but one Democratic House member joining with the majority of Republicans in supporting the measure. So it did end up gaining a majority in relation to passing the bill, bipartisan. However, there is still great issues around passing the long-term, budget. Now, Biden launched the stopgap measure the stopgap measure for preventing an unnecessary crisis which would have inflicted needless pain on millions of hardworking Americans. Now, this is not the first time we've seen issues of a government shutdown around a US budget being passed. This tends to happen during an election cycle, when possibly the majority party or the leading party of the president ends up losing the majority of his party in one of the chambers, whether that be the Senate or the House of Representatives, and as a result there becomes a great issue where where the two parties then try to work together to form a good deal and bill. Now, Biden also added, in response to the Ukraine issue, that we cannot, under any circumstances, allow American support for Ukraine to be interrupted. And this has been seen, Joe Biden's kind of reiterated this message since the start of the war, supporting Ukraine, supporting, humanitarian and lethal aid to Ukraine, which helps Ukraine every single day, to fight back the Russian invasion. Now, Schumer and McCarthy did respond, however, saying, with the eyes of our partners, allies, and adversaries upon us, we keenly understand the importance of American leadership and are committed to strengthening it from Europe to the Indo-Pacific. So it seems clear that these two party leaders are still interested in maintaining a level of support for Ukraine within the chambers of the US Congress. Now, the scale of Saturday's rebellion will raise further questions about the strength of McCarthy's leadership, with several hardline Republicans, including Florida's Congressman Matt Gaetz, suggesting they were prepared to bring a motion to vacate or a motion of no confidence against the Speaker. And it's kind of interesting to see this, how we're starting to see this kind of rebellion within the Republican Party, which are more Trump loyalists. After all, these are more anti-establishment candidates, and therefore they're kind of opposing the more status quo leadership of Kevin McCarthy, which more so wants to work with Democrats on bipartisan issues. Now, a shutdown had appeared all but certain on Friday after 21 Republicans voted against a different stopgap measure. And this was also in line with the majority of Democrats also not supporting the measure due to the fact that it cut funding for too many sectors for the Democrats' liking. And so this wasn't really just an issue in relation to, the Republicans not wanting to pass anything, but also the Democrats not also wanting to compromise on certain sectors which they deemed necessary for the government, and therefore they weren't happy to pass any bills which sacrificed that, sacrificed their morals just for passing the temporary measure. Now, Democrats had placed blame, however, for the shutdown threat on Republicans, given the small but powerful majority of hardliners in the House who hindered several compromise deals in recent days. And these are kind of Republicans which do not want to back down at all, including Marjorie Taylor Greene and, as we said, Matt Gaetz. But continuing on, the next article to really talk about here is British exporters, which face a hefty EU carbon tax after the Sunak weighs in climate policies. Now, Rishi Sunak's weakening of the UK's climate targets have left British exporters facing hundreds of millions of pounds in EU carbon border taxes within the next decade. Now, this is a kind of combination of two issues within Britain and its trade, those two being its existence around green policies, as well as its relationships with the EU. And this is where it's really come into contact, where the EU is trying to hold this high green standard, sustainability standard. However, Rishi Sunak's pushed back on the climate targets, obviously, in many places in favour of supporting working class families, which were going to be hit hardest, which was claimed to be hit the hardest by these green policies, and therefore he's pushed it back so it can be implemented at a slower and more effective pace, according to him. And this is kind of now hurting British exporters due to the fact that when you trade with the EU, obviously they don't want you to be exporting loads of really damaging products or chemicals or capital goods which have required lots of greenhouse gases to be emitted. Now, the UK carbon market, which sets the price tag, the price large manufacturers and energy companies must pay for every single ton of CO2 released, as I said, and has collapsed after the Conservative government weakened a number of green initiatives. So the price of that within the UK carbon market is obviously dropped after they're pushed back the targets, so you don't even need to keep to that level of standard anymore. Now, with the UK's emission prices falling to less than half of the EU's equivalent in recent months, having traded nearly a penny, nearly a parity, and this was the case when a lot of these Western nations were on the same kind of wavelength in relation to their green policies, and therefore, as it's now been pushed back, this has caused the UK's carbon market to crash. Now, with the UK and with the EU's incoming carbon border tax, which penalises countries with substantially lower carbon costs than the blocs, the drop in the UK's emission prices mean that British exporters will become liable for the tax when it comes into force for 2026. So this obviously is going to have a great effect on British exporters, which will now be taking on the cost of their CO2 emissions. Now, with the lower emissions price also meaning that the UK Treasury will generate less revenue from carbon pricing, and the UK industry will still be paying for emissions on exports to the EU, but instead of taxes going to the Treasury, they'll be headed straight to Brussels, which has earmarked these revenues for a further investment into renewable industries, said Marcus Ferdinand. And the total UK exporters would pay to the EU could easily rise into the hundreds of millions of pounds by the next early next decade, if the gap in carbon prices remains. Ferdinand said, that's the issue which is really around at the moment. Now, even electricity exports from wind farms, solar and nuclear energy plants will also be subject to carbon import taxes as a result of 40% or more of UK electricity still being generated by gas or coal. So they can't really find out how much what energy that the UK is exporting, which is carbon neutral, which is sustainable, and which is dirty, and therefore it forces the EU to just say, well, all of it must be dirty, and therefore we're going to have to tax you on that. And this, as a result, is having a great effect on the UK's export in the energy market, with the Deputy Director of Energy UK saying, UK companies that are exporting to their largest market will have a significant tax imposed on them that will go into the EU's budget once it has gone to the exchequer, which would have gone to the exchequer, And so we're in an interesting position for the UK, where though they're revising and pushing back their green targets, which would ideally be done in a process of lowering the cost of living, as well as boosting growth, because you're not limiting yourself to these sustainable policies. Although this may be the aim, it could actually cause a decline and some issues within the manufacturing sector, as we've spoken about, due to the export market being hurt with the UK's largest trading partner. But next to talk about really is Rishi Sunak, which is sort of on the same wavelength, but this in relation to the Tory party conference. Now, Rishi Sunak has refused to commit to tax cuts before the next general election, despite the growing clamour from both his cabinet and backbench MPs for giveaways. Now, the Conservative Party members gathered in Manchester on Sunday for the start of the party's conference, with the Prime Minister saying his top priority was curbing inflation. Now, we know this has been a large issue for the British government and the Conservative Party, with obviously inflation rising across the world. But obviously for any party in power, this causes a large political issue. And so although the central bank is apolitical, is away from the government, it is an issue for Rishi Sunak, which he apparently has to solve. And therefore it puts the party in power always in a difficult situation of where they're trying to lower the cost of living, but really it's the central bank which has most of the control over the issue. And therefore, Rishi Sunak has committed to halving inflation. However, it's hard to see how he will actually be able to do this without the ability to mess with interest rates on his own. And obviously rising interest rate already has its own issues. And so certain people have called for, the lowering of taxes. However, Rishi Sunak's basically saying it's not the taxes which people need cutting, it's inflation which needs cutting, which some people call an invisible tax anyway. Now, he said, as I was kind of commenting there, he did say the best tax cut that I can deliver for British people right now is to halve inflation. With Michael Gove, however, pressuring Sunak and Jeremy Hunt on the matter, saying, taxes are higher than what we'd want them to be. I would like to see the tax burden reduced before the next general election. We know, a large part of the Conservatives' drive and voter base do have interest in lower taxes. That is one priority and policy which they're interested in for numerous reasons of growth, and just the right to hold on to as much money as you earn. And therefore, as we're kind of leading into this next general election next year, it'll be interesting to see how Rishi Sunak will respond to this, while wanting to keep tax rates where they are for obviously budget reasons and that sort of thing. So it'll be interesting to see how that plays out, with him also trying to lower inflation. And say Michael Gove also did say, that we should incentivize people to work harder. We should make sure they are rewarded for their enterprise, the effort and the endeavour they put in. So essentially, this is the two different dynamics and messages within the Conservative Party at the moment. One being on the Sunak side, kind of saying, look, we need to focus on inflation, get inflation down. And then you've kind of got the Gove side, which is saying, look, inflation's high, but we can't do that much about it. It's probably best off that we help people by lowering their taxes. But that said, if taxes are lowered, there's always the risk of furthering the issue of inflation by causing aggregate demand to rise further, as if income tax is cut, consumption will likely rise, therefore pushing AD up and inflation with it. So it'll be interesting to see how that will play out, with Sunak forced on Sunday to insist that Britain was not a laughingstock, as he refused to comment on whether he would press ahead with plans for the Birmingham-Manchester leg of the HS2 project. And obviously this is a very controversial issue as well in relation to high speed rail within the UK, and the targets for how long and how far this high-speed rail project is planned to extend, and the cost of it, has been ever changing. With the very start, being that people expected HS2 to go to Leeds, and with some even asking it to go to Scotland, and now we're in the situation where it might not even extend to Manchester, which is a massive decline in the expectations of HS2, and kind of killing a large part of why they did it, and it really begs the question of whether it's worth all the money if all you're doing is building the rail between London and Birmingham and not even going to Manchester. So it'll be interesting to see how that plays out, and with all the scrutiny on Sunak, it does seem tough for him to manage going into next year's election year, with Sunak also being pressed by the BBC on the public's thought of his wealth, and that being the main image that people hold of him, as well as being challenged by the boss of Iceland, who commented on the Tory party leadership, saying they were drifting out of touch with both businesses and just general consumers and individuals. That said, Kemi Badenoch, the business secretary, did say that Britain quitting the ECHR needs to be on the table, and this is kind of coming as the illegal immigration issue, with stopping the boats in the English Channel, is becoming an even bigger issue by the day, and a more kind of significant one on people's priority list, especially Tory party members, with many One Nation Conservative MPs, however, being opposed to that idea, as well as some other cabinet ministers. And we know that ECHR has played into effect in limiting the UK's ability to implement certain asylum policies and refugee, kind of deportation policies, which it's kind of prevented on a human rights argument. And this all comes after the illegal immigration issue becomes the most important issue to Conservative voters. But that's all to talk about for the articles, really. Keep your eyes on those 3 stories. It'll be interesting to see how they play out. But next to talk about, really, is the charts, with first starting on the US 30 and US indices as a whole. As we can see here, on the Dow Jones, following that decline, which we did follow for some time, following the Fed's rhetoric around, keeping rates where they were, but possibly raising them later this year, it did cause US indices to sell off as they began to price in, higher rates. But as we saw, although it did fall off, we kind of saw this bounce back a bit to the upside, where we managed to touch the 38.2% fib. And there we kind of responded, continuing to the downside, it does seem. So it'll be interesting to see whether on the US 30 we will continue lower from this 38.2% area, or in fact maybe it finds liquidity at this prior low and continues higher. And this is kind of an image that's reflected across the US indices, where they've kind of pushed up, as we did talk about on the US 30 as well. We were in this channel after declining for some time. We were kind of ranging there, and then we did push higher, nearly reaching the 61.8% area where there is liquidity. However, it did seem to fail to reach that area, and it does seem that it's kind of fallen off since then. And same on the S&P 500. But next to talk about, really, is the dollar, which is in a really interesting spot because it did decline coming into the end of last week. However, as we did highlight, this 50% area, did end up becoming a significant area of liquidity and support, where the dollar was able to respond to the upside from that area and is now begun a move higher. So it'll be interesting to see whether this is actually the top of the dollar's rise following the Fed's rhetoric, or in fact the dollar will continue rising from that area. So keep your eyes on the dollar. Next to talk about, really, is euro dollar, which is also in an interesting position, obviously following the movements of the dollar, but also following the fundamentals of the euro, which last week did receive inflation data, which showed inflation was down more than expected. This, of course, did cause a bit of a sell-off as people began to realise, wait, maybe this will cause the ECB to lower rates earlier and therefore decrease the value of the euro. And so we kind of saw a response off the 50% Fibonacci area, where we knew there was some liquidity around here. I kind of expected more of a move from the 38.2% fib, which we did sort of see, but however it did push higher and now has started to fall off the 50% area. So it'll be interesting to see whether it will fall lower from there. But next to talk about, really, is pound yen, which we've been talking about a lot recently, but we did think initially when it came up to this 50% area after breaking out of this, prior channel, we did think, okay, it's going to continue falling from this area. However, it did kind of find some liquidity somehow and continue higher, retracing to the 78.6% area, where it does seem to have had, a very strong reaction, almost, coming into contact with the bottom of this channel, and has now begun to fall away from that. So it'll be interesting to see whether this will be the end of this retracement and now it will continue down to the downside. But next to talk about, really, is gold, which is in a very, very interesting spot, because following the Fed's rhetoric in relation to, how rates were going up later this year, this did cause a lot of buybacks of the dollar, as people kind of priced in, that rhetoric with, more dovish rhetoric coming out from the Bank of England and the ECB, whilst there was more hawkish rhetoric from the Fed, did cause, a lot of this money within the euro and the pound to move into the dollar. And as a result, when the dollar goes up, generally gold has the inverse reaction, and this is kind of what we've seen with gold declining greatly and spiking even further to the downside. So it'll be interesting to see how gold will play out going into this week's of NFP figures, which obviously, always has a very influential impact on gold. But lastly, to talk about, really, is oil, which, although we've kind of been expecting, especially Brent crude oil, to kind of reach the $100 a barrel mark, it does seem to continue finding issues and resistance in finding that area, and it did decline off the back of last week, and therefore, it's now in this interesting position of sitting around the 61.8% Fibonacci area. So it'll be interesting to see whether it will move away from that area, or in fact it will continue lower. These prior lows around here at the 88.7 area. But that's all for the charts. Next to talk about really is the economic calendar, which is always important to end with, obviously, with lots of economic data coming out this week, obviously, as I commented around NFP. But firstly, we've got ISM manufacturing data coming out, so obviously that'll be important to understanding how the US industries are functioning. As well as that, we've got the Aussie interest rate decision, so make sure you know that if you're trading any AU pairs. As well as that, we've got Italian GDP growth rate, which obviously always plays into the ECB's policy, with these major EU economies obviously always having a great effect on the euro. As well as that, we've got the US ISM services data coming out, so keep your eyes on that, because obviously that's in the same week as manufacturing data. As well as that, we've also got Canadian unemployment data, and obviously if you're trading any Canadian pairs, that's going to have a great effect, because obviously unemployment signals to the Fed, to the central bank, what to kind of do. As well as that, we've also got the US NFP figure, which will obviously have a great impact on the market. So that's the really significant one of this week. And that'll be taking place this Friday, as well as the US unemployment data, which will come out at the same time. So make sure you hang around for that. I hope you have a great trading week. But yeah, that's all for us at Wildwood Capital. Have a great one. See you. Bye.